In this video, I'm going to show you how to avoid the 5 most common mistakes I see when looking at capital gains tax calculations for investments in shares and ETFs. As an accountant, I see taxpayers making these mistakes when calculating capital gains tax all the time, and I want to show you how easy it is to avoid them. So what are these common mistakes? Number 1. The first mistake that I see all the time with capital gains tax calculations is not including the cost of all share purchases in the cost base of an investment. It sounds simple, but it's very easy to do. If you're accumulating shares frequently over many months and years or participate in a dividend reinvestment plan or DRP, then the chances are your cost base may not include everything and you could pay too much capital gains tax when you do eventually sell. As the formula for calculating a capital gain is sales proceeds less the cost base, having a lower cost base means a higher capital gain and then a higher tax bill. The most common purchases of shares that I see get missed is from years of participating in dividend reinvestment plans or DRPs. The longer you are in a DRP, the higher your cost base should be. I have personally participated in a DRP for one investment alone for over 20 years, and the cost base of those DRP acquired shares exceeded my first and only purchase in that investment. So missing the DRP purchases would have cost me a lot of extra tax that I didn't need to pay. So make sure you are keeping track every time you are paid a dividend while in a DRP of the number of shares you were issued and the price you paid for them, and store them somewhere safe. This can require a lot of discipline, especially if you plan to be in a DRP for many years. The second mistake I see with capital gains tax calculations is taxpayers not adjusting the cost base for corporate actions like demergers and capital returns paid out each year in cash. Sometimes companies enter into a demerger for one of their businesses growing fast, where they separate it from the main company and operate it in a newly listed company with separate shares issued to you at no extra cost. However, there is a cost to you from a demerger that usually requires you to reallocate part of the cost base of the original investment you held before the demerger to the new company. This cost base adjustment from a demerger would lower the cost base of your original investment and increase the cost base of the new investment coming out of the demerger that you were issued with. I have seen many taxpayers not allocate any cost to the newly demerged company that they own shares in and calculate 100% capital gain when they sell it, which is incorrect and can result in too much tax. The other common cost base adjustment that is often forgotten in capital gains tax calculations is the payment of a capital return. Capital returns are paid to investors in cash over the years, which looks like normal dividends. However, they are not dividends, and they are usually not taxable in the year they are paid to you. Capital returns still need to be kept track of over the years, as they cause cost base adjustments both up and down to either lower or increase your cost base of your investment, so you will eventually pay either more or less capital gains tax when you sell the investment. So tax is essentially deferred until you sell your investment. For ETFs and other listed trusts, these capital returns are shown at the bottom of the annual tax distribution statement like this here, on a separate line called AMIT cost-based net amount that are either an excess or a shortfall. For shares, you may receive a dividend or other payment statement that advises that you have been paid a capital return. Capital returns are fairly common with ASX listed property trusts and most common ETFs. Capital returns typically lower the cost base on average, so make sure you keep track of these items contained on your annual distribution statements carefully each year at tax time to ensure you pay the correct amount of capital gains tax when you do eventually sell. Number 3, the third mistake I see taxpayers make with capital gains tax calculations is not subtracting capital losses from capital gains before applying the CGT discount of 50%. The 50% CGT discount applies only to individual Australian tax residents when capital losses from other investments are subtracted from current year gross capital gains during the tax year. I've seen taxpayers subtract the 50% CGT discount first and then reduce the capital gain left over by capital losses second. It is a subtle difference, but not doing this step in the correct order could mean you end up not paying the correct amount of capital gains tax. This would also mean your carry forward capital losses into future years is not correct. Now, before I get to the next common mistake, could you please do me a favor and press the like button and subscribe to my channel if you found this video helpful, and also so you can get notified when my next video is uploaded. Having more likes and subscribers will motivate me to keep making these videos to help you. Number 4. The fourth mistake I see taxpayers make is thinking that a capital loss can be used to lower other taxable income like salary and wages. Unfortunately, in Australia, capital losses can only be used to reduce capital gains from the sale of investments. You cannot reduce any other income with a capital loss. You can carry forward any unused capital losses and use them against future capital gains. So not all is lost if you have too many capital losses in 1 year. Number 5. The fifth mistake I see taxpayers make is forgetting about unused capital losses from earlier years to reduce current year capital gains and paying more capital gains tax than required. Unused capital losses can easily be forgotten, especially if you don't sell capital assets very often, and when the time comes to use them, your records could be lost or forgotten. You must keep all records of unused capital losses brought forward from when the original loss was made. If you ever get audited, the ATO will expect that you have kept these records and can deny you from using capital losses if records are not maintained. So make sure you keep track of your unused capital losses and how you calculated them. So how do you avoid making these 5 common mistakes? When calculating capital gains tax, tracking ongoing cost-based changes, and keeping record of capital losses for listed investments like shares and crypto, you can make your life a lot easier by automating the whole process in real time by using free online tools. There are a few tools available, and I've been using a free online tool called ShareSite for the past 4 years. I use the free plan that allows me to track up to 10 investments at no charge, which suits me just fine as I mostly invest with ETFs and I never get close to the maximum of 10 investments. I also get to use the capital gains function and reports, which keeps track of all the changes to my cost base automatically and calculates capital gains tax in real time. I don't use my broker's online tools and reports to keep track of my portfolio or calculate capital gains tax, as I find they can become very inaccurate over time since they miss tracking DRPs and many other corporate events like capital returns and demergers over an investment's life cycle, especially for long-term investors with ETFs like me. I'll include a link in the description of this video for ShareSite if you're interested. For full disclosure, the video is not sponsored by ShareSite, but the link in the description is an affiliate link. Oh, and if you did choose to upgrade, then by using this link, you would also get a discount of 4 months free on your first 12 months subscription. The 2 videos appearing on your screen right now provide more information about capital gains tax in Australia and some of the issues with tracking share portfolios accurately, and I recommend that you watch one of them next to learn more. See you in the next one.